Hey, good morning, options traders, and happy hump day to everyone. And this video comes to us as a special request from one of the traders in our group who was referring to an older video that I did on put call parity. And he mentioned a couple of points in the video where he said it completely lost me and they were real sticking points. So I thought, well, it could be a sticking point for other people as well. So why not? Let's do put call parity revisited. We'll do the same concepts but from a little different perspective, and hopefully that will help to clear things up. So let's get started with put call parity revisited. As always, before we do, please be sure to click like and subscribe. Greatly appreciated and helps to promote the channel. So put call parity, I'm going to start off a little differently this time with a discount bond because this is a critical point to understand. If we have in the market what's called a discount bond, what you're going to do is to buy it at a discount from the face value. So a very common one is a government T-bill, a treasury bill. Let's say that it has a 1,000 face, which means that when it matures, you get paid $1,000. And what you're going to do is pay less than 1,000. That's why it's called a discount bond. And then it will, of course, mature to this $1,000 face. And the difference between the price that you pay and this $1,000 maturity value acts as your interest. So how much do we discount this bond? Well, there's an easy formula. And if interest rates are 5%, risk-free rate that is, then we're going to take our 1-year $1,000 face and we're going to divide it by 1 plus the interest rate. Interest rate is 5%, so 1 plus 0.05 is 1.05, comes up to 952.38. And that means that you would pay $952.38, and when it matures in 1 year, you're going to collect $1,000. So effectively, you have collected $47.62 in interest. But notice that it didn't really pay any coupons or interest. It's just the fact that you bought it at a discount and sold it for face value. So what's that percentage? Well, if we take the $47.62 effective interest divided by the $952.38 purchase price, no surprise, it comes up to be 5%, exactly as it should. So this is one of the key building blocks to understanding put-call parity, this whole idea of a discount bond. So keep that in mind, kind of hold that thought for right now, and then let's get into put-call parity. So you've heard me say many times that a call is a put and a put is a call. It really just depends on how we delta hedge them. Anything you can do with a call can be done with a put. Anything that can be done with a put can be done with a call. So for anybody who might be new to strategies, they might say, oh, I saw somebody do a butterfly spread with a call. Can you do it with puts? Absolutely. Anything that can be done with a call can be done with a put. So there has to be a reason for this connection because they seem so different. And there is a formula that shows the equivalence of calls and puts. And that's what the put-call parity formula is about. The word parity is just a fancy word for equivalence. And there are a lot of different parity equations in economics and in the financial markets. Like we have a covered interest arbitrage or covered interest parity. There's all kinds of parity equations. So the one that we're going to use for put-call parity is stock plus put minus a call equals a T-bill. Now, of course, if you're good with algebra, and we'll look at some examples later, you can rearrange this into any number of ways, and each one will tell a different story. And so anytime that we have a letter like this, the stock, without a sign to the left of it, there's no plus or minus, it's assumed to be positive. So what this is telling you is that a position of long stock plus a long put plus a short call, that's what the minus sign is, will behave just like a T-bill. Who would have thought we take these risky options, everybody talks about how risky options are, and we combine them in such a way with some shares of stock, and we get this new potion that actually makes it behave like a risk-free treasury bill. Crazy. Now, incidentally, for this formula to work, the call and put strikes have to be the same, but they do not have to be the same as the stock price, so they don't have to be at the money. but we need the call and the put strikes to be the same. So we'll see some more examples later, but just kind of keep that in mind for right now. So how could this possibly work? How can we take, again, a risky call and put, combine it with shares of stock, and get something that's completely risk-free? Well, to understand what's happening here and why this formula works, let's consider a call option trade. So let's say that the stock is trading for $50 per share, and you want to buy 10 one-year $50 calls. Well, what are these call options worth? So let's say that the market maker or the ECN or some computer algorithm somewhere has to figure out what these calls are worth. So I'm going to go back to the days when we had market makers, and I think it makes the instructions a little easier to follow that somebody's actually calculating this stuff. So the market maker is going to say, well, if you want to buy these calls, I have to sell these calls. Market maker has to be on the opposite side of the trade. So now the market maker must sell these 10 $50 calls. Well, the first question that I have for you is, what's the market maker's risk? What does the risk graph look like for a short call option? Well, if he's short the $50 call, we know he gets a bend at 50, and this is the risk graph. So what do you notice here? We have unlimited upside risk, and that's probably something scary in anybody's book. So who wants to do this? Well, probably the market makers don't want to do it either. So they recognize that they have to take the short call in order to fill your order as the long call, but they'd probably like to hedge this risk. All right, so we have this unlimited upside risk. It's upside because as the stock price rises, we start heading into deeper and deeper losses. So how could the market maker hedge this upside risk? Well, to counter this upside risk, the market maker might buy 1,000 shares of stock for the current price of $50. So the first thing to notice is that that's going to cost $50,000. So you can see that the business of market making can get expensive quickly. And now this should also help you to understand why there is an interest component to a call option. Market maker's got to part with $50,000 out of his account here, and now he's missing out on interest. So that's going to get factored into the price of those calls. Now, some of you might recognize this as a covered call. So the market maker, remember, we're looking from his perspective. He just bought 1,000 shares of stock, and he's going to sell these 10 calls to you. So he's long stock and short calls. That's a covered call. But when you do that, yes, it removes the upside risk, but it creates a new risk. What is it? Well, this is now the change in the risk. This is the first risk graph that we saw, the short call. And this was one of the sticking points that I think the trader had. So let's do an overlay here. So this was the short call that the market maker had, and he just now went out and bought 1,000 shares of stock. So now it goes to this. He's got long shares of stock in black, and he's short these calls in red. So take a look where the two trades are equal. And over to the left, this flat line in red for the short call, those are 0 deltas, flat. Over here on the right is minus 100 deltas. It's behaving like short shares of stock. Now the long shares of stock we know are delta 100 always, so this area up here to the right of the blue line is going to be plus 100 deltas, and to the left it's going to be plus 100 deltas. The long stock is always plus 100 deltas. So now take a look at what's happening. To the left of the blue line we have plus 100 plus 0 is what? Plus 100. I should have 100 deltas to the left of the blue line, which is that black line. Over on the right, what happens? I get plus 100 combined with minus 100 gives me 0. So to the right of the blue line here, we should flatten. So by looking at these two overlays, you should recognize that we're going to have this long tail over here, positive deltas, and then we are going to flatten out. And that's exactly what we get. So this is our covered call. But now what happens? Now the market maker has unlimited downside. And that's why I said before, calls or puts, puts or calls, depends on how we delta hedge them. We had a short call that had unlimited upside. We go and buy the stock. Yes, it erases the unlimited upside, but it now introduces unlimited downside. So what are we going to do here? The poor market maker's thinking, gee, how can I escape this risk? What could I do to hedge the downside? Well, what could we do here? So to counter the downside risk, the market maker might buy $50 puts. Puts give you the right to sell at 50, so for all stock prices below 50, the market maker is guaranteed to get 50 bucks. Now remember, the calls and the puts must be the same strike. So that's why you have to buy these $50 puts. So what's the resulting position after all of this? Well, if you remember, the market maker bought 1,000 shares of stock. He just bought that long $50 put, and he's also short the $50 call. And his primary goal for shorting this $50 call was to fill your order that was a long $50 call. So these three pieces right here, long stock, long put, and a short call, make up a special type of a trade or a strategy called a conversion. Now, before you get too excited about it and say, oh, it's completely risk-free, that's true, but you as retail traders are going to be buying on the ask and selling on the bid, so you're probably going to be buying this T-bill, let's call it, at greater than face value. So it's not really a strategy for retail traders. It's more of a market-making type of a trade, and it's called a conversion. Now, incidentally, the trade on the other side of this, short stock, short put, long call, would be called a reversal or a reverse conversion. So what's special about this? What makes these three pieces, this conversion, so special? Well, here it is. We've got long stock at 50, long $50 put, and a short $50 call. And the secret to understanding put-call parity is that these three pieces create a guaranteed sale of stock for 50,000 bucks. So let's take a look at what happens. Let's assume that the stock price is exactly 50 in 1 year. Remember, these are 1-year options, and I'm doing that just to make the math easy. Well, if the stock is exactly 50, these options expire worthless, and the market maker can sell the stock for $50 per share and get 50,000 bucks. What if the stock is above 50? Anywhere above 50? Well, the $50 put expires worthless. The market maker is short this call. What happens? He gets assigned and loses the shares. He gets paid the strike. So again, he's going to collect $50,000 cash. What happens if the stock price falls? Anywhere below 50. Well, now the call option expires worthless, and the market maker is long the $50 put, so he can exercise and collect $50 again. So no matter what happens, whether the stock stays still, goes up, or falls, the market maker is guaranteed to get $50,000. And what does that sound like to you? Sounds like a T-bill, 50,000 face T-bill. So now the question is, how will the market maker price this $50 call? Remember, that was the goal at the onset. You wanted to buy these 10 contracts. The market maker's trying to figure out what this call is worth. Well, we said that the market maker had to pay for the put. Let's just pick a price and say it was $2. Now, it turns out it does not matter what this price is. It will get factored into the price of the call. That's the beauty of put-call parity. So just pick a number. Let's say that the market maker pays $2 for this put. So let's recall what he's done. He paid for the stock $50,000, 1,000 shares at 50 bucks. He bought the $50 put for 2 or 2,000 because remember, this is 10 contracts. And the question now is, what should he sell the $50 call for? What's it worth? Well, let's look at what's happened. He has spent $50,000 plus 2,000. He spent $52,000 so far. Now he's going to receive a credit for this call, but right now he is out 52,000 bucks. So how can we use this information to figure out what this call is worth? Well, go back to something we figured out already. He's guaranteed to receive 50,000 bucks. Well, if this is in 1 year, question is what's it worth today? And we know how to figure that out. If the risk-free interest rate is 5%, this package is worth $50,000 divided by 1 plus the interest rate, $47,619 today. How can we check our math? Well, if you deposit $47,619 into a bank paying 5%, look at that. It will mature to $50,000 in 1 year, exactly as it should. So this $47,619 is called the present value of $50,000 in 1 year, assuming that interest rates are 5%. $50,000 is called the future value of this $47,619. So we just figured out that this package is worth $47,619. But the market maker overpaid for this. Remember, he has spent $52,000. He spent $50,000 on the stock and $2,000 on the puts. But as we just figured out, the package is worth $47,619. So how much did he overpay for this package? The difference is $4,381. And there's your answer. Remember, he's going to get a credit for selling you those calls. You're going to get the debit, you're buying them. He's going to collect that money. So he's going to make up this difference, the amount that he's overpaid here, by selling the 10 calls for $4.38. And that's a very long roundabout way of showing what the Black-Scholes model is doing. It's a different approach, but we can do it by keeping the position hedged. So let's look at the transactions again just for a recap. Market maker bought stock, he spent $50,000. He bought the put for $2,000. He collected $4,381 from selling the call, and the combination of all of those cash flows comes up to $47,619, which is just like a T-bill. That's exactly what the 1 year T-bill would cost. So think about it. We just calculated that this call should be worth $4.38. Well, let's go to a pricing model and see if it holds up. We've got the stock price at 50, strike at 50, 360 days to expiration, interest rates at 5%. Now, I've chosen this kind of seemingly odd volatility number of 15.76. Why? Because that's the volatility necessary to make this put worth 2. And earlier in the presentation, I said, let's just pretend that it's trading for 2. So given the fact that the put is 2 and that we have 1 year to expiration, and we've got this volatility, stocks at 50, and we've got a 50 strike, what do you suppose that call option is worth? What is the Black-Scholes model going to tell us that it's worth? Well, there it is, $4.38. Exactly what we calculated. So put-call parity is, the formula is going to take long stock plus a long put plus a short call. Remember that the option strikes have to be the same, and it will behave just like a bond. And that's where the formula is coming from. Shares of stock plus a put plus a short call equals a T-bill. And once you have this formula, feel free to rearrange it any way that you want algebraically. And I've talked about this in another video, that each arrangement kind of tells a different story. But this is the put-call parity formula, and now you've got very good insights where it's coming from. Now, there's another little thing that we have to talk about. I've covered this in previous videos as well. This is what's called the full put-call parity formula, because it contains the bond or the T-bill. And so there's really two different put-call parity formulas. One is called a replicating formula, and another is called a mimicking formula. So if we take stock plus put minus call equals a T-bill, this is the full formula. And what that means, it's going to keep both sides of the equation exactly in balance. If one trader has $10,000 in the position, then the synthetic will have $10,000 in value. And they will change up and down exactly the same. But for trading purposes, most of the time we're worried about the mimicking portfolio, where we're just going to forget about the T-bill. And so we're just going to say stock plus put minus call equals 0. Let's just forget about the T-bill, and we'll use this formula. So let's take a look at some examples. Let's start with our put-call parity formula. Let's take stock plus put minus call. That's what you're always going to start with. And then you're going to say equals 0. Or you could just leave this right side blank. And so what we're going to do is solve for different pieces. Let's say we want to know what a synthetic call is. Well, I've got a short call already on the left-hand side, so we know algebraically I can just add a call to both sides. A shorter way is to say, let's just kind of picture putting our finger on this minus C and sliding it over to the right side of the equals. And when we do, we have to change the sign. So watch this. And there we go. It is telling us that a long call is the same thing as long shares of stock plus a long put. We would say that the stock plus put is a synthetic call. Why? Why would we call that a synthetic position? Well, if we look at the profit and loss diagram for a call, we get our typical hockey stick graph with our bend right there at 50. What do you suppose the risk graph looks like for stock plus put? Exactly the same. That's why they are synthetic equivalents. So that's how we know that a stock plus put is going to behave exactly like a call. Let's try another one. Let's go back to the basic formula. Stock plus put minus call equals 0, or just leave this side blank. What is a long put? We want to know what a synthetic long put is. Well, I've already got a long put on the left, so let's just swing the stock and the short call to the right. If I put my finger on the S and slide it over this way, I end up with a short stock position. Remember, we have to change the sign when we cross the equals, because what I'm really doing is subtracting S from this side, which cancel, and then I'm subtracting S from this side. But now I still need to get the put by itself, so I have to take this minus call and swing it over to the right, and when I do, it becomes a long call. And there we go. A position of a short stock plus a call will behave exactly like a long put. So short stock plus a call is synthetically a long put. What do you suppose those risk graphs look like? Well, there's your long put. We get our bend at 50. There's our negative deltas. And if we look at the short stock plus call, look at that. Exactly the same. So the main thing to get from this is that it really comes down to the stock plus put minus call formula, keeping in mind that the call and put strikes must be the same. And if you do that, all you have to do is rearrange that formula and look at different versions. And that is the way that you can always figure out a synthetic position. So there are 6 basic synthetic positions. You should be able to figure them out. We have one that's stock, call, and put, and then we just flip them. We have short stock, short call, and short put. So as an exercise, just go through and see if you can figure out the 6 basic synthetic positions. And if you have questions, post them to the Facebook group, and I'll be happy to answer them. So for now, I hope that helps to understand a little bit more about the put-call parity formula. It's a really powerful way to understand your synthetics, and when you understand synthetics, it'll help you to find hedges and morphs in the markets that you might not otherwise see. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.